Let me just make two brief comments before we get started with the first paper. The first comment is that we have tried to group papers into topics. I mean, this is not always easy, but I think that you will appreciate that somehow there is some theme that goes through all the sessions in this conference. And the theme of this first session is on interest rate risk, something that obviously brings the connection between monetary policy decisions, interest rate risk, and financial stability, one of the themes of this conference. The second thing that I would like to say is that the time is very tight. Timing is very tight, so I will ask the speakers to stick to the prescribed times. 25 minutes for the presentation, 10 minutes for the discussion, and 5 minutes for general discussion, and I will use these cards to sort of tell you how you're doing with the time. Okay, right, so the first paper is by Rainer Haselmann and co-authors, and it deals with interest rate risk using a very nice sample of German data. And the second paper by Paolo Varraso is also looking at interest rate risk, but using data from the US. So now, without further ado, Rainer, the floor is yours, and you can start.
So thank you very much, Rafa, for the invitation. And my paper is on interest rate risk, deposit rates, and financial stability, joined with Puriya Abbassi and Iliriana Shala, both from Bundesbank. And given their affiliation, the usual disclaimer applies, especially when I present and give my own views to the story. So what we are trying to do in this paper, we're going to look at the transmission of monetary policy to rates. And on the asset side, there is a large literature on this, and I think by now we have a very good understanding on how this works. There are the seminal papers by Bernanke, Gertler, but also my discussant has written a couple of very important empirical papers that allow us to understand how monetary policy rates transmit to loan rates and then impact the real economy. There has been much less research on the link of monetary policy rates and the deposit rates. And we believe this is very important for particular financial stability reasons, because when banks do extreme maturity transformation, there can be interest rate risk. The current view that we have on this topic is mostly shaped by the work of Drexler, Philip Schnabel, and Savoy, and they identify a presence of deposit franchise value, which serves as a hedge against interest rate risk, which means that banks either have, I mean, there are now a bit controversy in this literature that there might be different reasons for this. It could be market power of deposit rates. It could be what Juliane Begenau argues, uniform deposit rate setting by large banks that is somehow hindering transmission of money of these rates. And by this, banks generate rents and have a protection or hedge against sudden increases in rates. And experiencing the situation in 2022 in Germany, we felt that there are various reasons why we find it hard to believe that this can be the only story, and we try to understand better why there's so little competition. I mean, most people I know or we knew were somehow trying to get higher interest rates, and they were calling up different banks, and banks in Germany at the time did not offer higher rates. And as an economist, I find it hard to understand, because they're very profitable business opportunities. There's a paper by colleagues at Bundesbank, by Carol, that shows if you leave as ECB reserves, you already earn very high spreads, but you can of course issue also new loans. And so it's surprising that banks don't bid up the rates, that they remain so low. So we think there must be something else that is impairing this transmission, and we do believe that it's actually potentially interest rate risk itself that is impairing this transmission. So that is our conjecture that we're going to test in this paper. We believe that we were before in a period of negative interest rates. Deposits actually had been a problem, particularly for banks that had a lot of deposits. So because mostly they were not fully transmitting the negative rates, they kept zero interest rates, and then banks, we can see in the cross-section there has been some research, again by my discussant, but also Florian Haider has written an important paper on banks being forced to take on excessive risks if they lose money on their deposits with negative rates. And we can see actually that before this interest rate shock occurred, that there's a quite heterogeneity among banks, in particular the regional banks in Germany took up enormous, we have fixed rates on mortgages, and there was an interest rate boom, and we can see that banks have actually done a very intensive maturity transformation. And once there is this interest rate hike, you can look at the market-to-market valuation, and you can see that actually many of these fixed rate loans have enormous losses. And once you have these losses, you are somehow hindered in the transmission because you cannot go to the market and fund yourself with these negative NPV loans you have on your balance sheet. And on the other side, you cannot offer much higher rates because then you would make losses. And we believe that this is a very important issue that's hindering this transmission to depositors. So the research question I'm going to present empirical evidence on is whether interest rate risk impairs the transmission of monetary policy to deposit rates. And we're gonna do, actually, this paper has two parts. We're gonna look at the setting in Germany. We use the Euro system data, and that is very detailed by now, and we have two parts. The first part is a little bit similar to the paper that Amit Zeru and his team has written for the US, where they do a market-to-market valuation of the assets of the banks and want to see how the interest rate hike affects these valuations. And we determine these losses, and by doing so, we identify the franchise value and the forgone returns to depositors because of this impaired transmission. The second part, then, we try to identify empirically whether interest rate risk itself is really impacting the deposit rate setting by banks. And we want to see which factors play a role here, how it impacts deposit in and outflows and the profitability of banks. So as I said, there are several data sets. The unaccredited data gives very detailed information on individual loan exposures, on their interest rate, and on actually whether it's a fixed rate loan or a floating rate loan. So this allows us to determine the net present value of a loan at any given point in time. For interest rate setting, we have a smaller sample, unfortunately. There's the Zista, so at least the Bundesbank has actually not so much detailed information. It's just about 240 banks that provide this information here. But then you have very detailed information on different term deposits, on sight deposits and saving accounts. And this is linked with other data sets. So this is the event, a well-known figure to most people in this room. We show the ECB deposit rate, the short-term rate by the blue line, and we have from negative rates, so minus 0.5 to up to 4%, an increase within relatively few months. And the German Bund rate, the 10-year rate, shows that also long-term rates have been picking up by about 3%. So the first thing we do is we compute on a bank level the interest rate exposure by calculating a weighted average of the maturity of those loans. When a loan is floating, we consider this maturity to be zero because the interest rate is then just adjusting. So this gives you in the end a value of 10, for example, that would imply that the assets in the loan portfolio do have a fixed interest rate of 10 years. So this measure we calculate on the bank level, and then we can look at the distribution, and we can see that there's quite some variation, and there are banks that have very, very long maturities, and there are banks that don't have such a high proportion of fixed rate loans in their balance sheet. I have to say these banks are, and that is of course an issue for our identification, not totally comparable. So large commercial banks like Deutsche Commerzbank and these are banks which have not so much deposits. They are more market funded, and they have much less of these very long-term loans and assets on there with fixed rates, while smaller regional banks actually tend to be those where the maturity transformation is very extreme. So what we do next is really just a version that's a little bit more detailed than the CERU paper on the monetary policy rate hike in the US. It's basically providing a market-to-market valuation of loans at each point in time. And so the formula gives you what are the cash flows of a loan, which you can see from unaccredited, for how many years is it outstanding, what amount will be repaid if it doesn't default. You have a probability of default given, so you can predict based on this PD the cash flows. One thing we don't have is the recovery rate, so we plugged in 40% for this one. And then the assumption in this valuation we do is that you cut the bank into two parts. You cut its assets and its liabilities in separate parts, and you assume the bank would fund all of these activities on the market. So we take the forward rates that the ECB is publishing for the different time horizons. So if a cash flow occurs in 3 years, we take the 3-year prevailing forward rate at this moment. And for assets and liabilities, we assume that both of those would be funded at a point in time after the hike, or at any point in time at the market prevailing conditions. And this is how we calculate then the net present value basically of each loan, and we can sum this up and can see what impact this has on loans. I mean, I have to put here one disclaimer. We have this unaccredited detailed data on commercial loans only. Mortgage loans, we don't have it. We can approximate it, of course, because we have the overall balance sheet figures. So what we have here is probably a lower bound, but of course commercial loans make up, because a lot of real estate loans are also commercial. So in this case, we do have the data on unaccredited, but the residential mortgages we do not have in this consideration that I'm gonna present you. So this is just telling us that there is a considerable majority of loans that has a maturity longer than 10 years. As you can see in the right bar, this picture, this snapshot is right before the hike in interest rates in June 2022, and the majority of loans has actually quite small interest rate. There are many loans with interest rates below 2%. This now is the result of the asset side valuation, and you can see that before there is a NPV of the loans of banks which are about 6%, and this has then dropped due to these fixed rate loans. You can see, if I look at the high interest rate exposure and low interest rate exposure banks, that the drop for those which have these high exposures, which have a larger fraction of fixed rate loans, this valuation has been considerably stronger, and it has been very drastic. There's a loss by having negative 13% here. You can see that this change in interest rate actually had a quite drastic impact here on the valuation. So we can use these numbers now and can see how does this impact the capital of banks. This is a Tier 1 ratio, and the Tier 1 ratio in the book value, how banks report it, and is a green distribution, and the orange distribution is the market value adjusted based on our valuation. And you can see there is a drastic impact. So in the two upper panels, here and here, you can see that actually the market valuation is better than the book valuation. So if you would do such a valuation, the banks would have more Tier 1 capital, but this has shifted drastically. The dashed line is the minimum capital requirements of the Tier 1 ratio, and you can see that the majority of banks, particularly on the high interest rate exposure, has shifted below, and that there's a considerable fraction of banks that has shifted to being totally insolvent. If you would if you would have accounting standards that would force banks to do a market valuation, this would have been a disastrous outcome for banks. So we can see that maybe it's also good because we didn't have a crisis so far that we have the prevailing accounting rules. And everything you can see in this table is shown here. You can see below that 70% of the high interest rate exposure banks would be insolvent, and that 81% would be below the regulatory capital requirements. After my co-authors have shown me these numbers for the first time, I went back to my office, and there are these newspapers, and I picked up a newspaper, and I was really concerned about the German banking sector when I saw these graphs. And then I read at the headline that German banks are doing record profits. The profitability at the same time is enormously high for German banks. So something must happen, and I mean the magic is the deposit franchise value, so you don't have to show these losses, and we can do the same exercise with the deposits. You can see here for the deposits, before the hike, actually, they have a negative NPV. So given the negative interest rates, having these deposits are actually have been a liability for the bank. But then if you don't transmit the positive deposit rates, these deposits are very valuable. Then in the end, because banks can get the high rates for their new loans, and they pay to all depositors in the beginning really a very, very low rate only, and they can put their money as reserves and earn high rates. We can see that in the end, the banks are doing good besides this valuation, and I think it's the depositors who are paying for these poor investments banks have done in the low interest rate period. They don't reserve anything on their deposits, and particularly with the term deposits and sight deposits, you can see that it's actually billions of euros that they are not obtaining. So what we are doing is now that I'm moving to the second part of the paper, and here we are trying to see whether the setting of deposit rates is impacted by this interest rate exposure, whether this is really the factor that does not allow you to transmit the deposit rates, and that's why you're not doing it, or whether it is really the classical story of the franchise value, that you have sticky depositors that are just not reacting, and that are keeping their money as a very stable funding base in the banks. I mean, it's not very easy to empirically differentiate this, but we are doing two separate identification strategies. One is the classical difference in difference. I have already said that these banks are not perfectly comparable. So what we're trying to do is we look into more homogeneous groups. So we are looking in the group within the saving and cooperative banks, which are more homogeneous, and want to see whether those that have been more aggressively in the real estate sector, having higher interest rate exposures, whether those are the ones that are in relative terms are setting lower interest rates compared to others. The other thing we are doing is, in the second part, is a IV strategy, where we say, okay, during this negative interest rate period, those that had relatively more deposits than other banks are also those banks which were more forced to do something with this money and did more risky investments, and doing more risky investments is likely associated with taking up more interest rate risk. And here we are doing the following thing. We are to make sure that this is not just another variant of the deposit franchise value. We want to see whether these deposit rates are explained by whether these high deposits explain the rate only after the shock or also before the shock, and we see that they do actually only explain it before the shock. So having a lot of deposits before did not really impact the deposit rate setting. So that's something that came into play after. So this is the first empirical strategy, the differences. In differences, we do have deposit rates or deposit inflows or outflows in separate regressions as a left-hand side variable. And we're going to look at the coefficient of interest. These are bank level variables. We don't have deposits on the individual level, the coefficient of interest is beta. That measures the different reaction of banks that have high or low interest rate exposure. We use a continuous variable here when we use a dummy for top 25 percentile and bottom 25 percentile. We of course lose a lot of observations, but results tend to be stronger. So the first result is here. These are still summary statistics. I'll skip them due to time. You can see already graphically that the interest rate, the deposit rates by the low interest rate banks, with the banks with low interest rate exposures, are considerably higher than the deposit rates after that are by those in the high interest rate exposure quartile. And we see this also in regressions. We can see that actually here, if we include bank controls and deposit type multiplied with bank fixed effects and time fixed effects, we can see that that those highly affected banks, those banks that had a lot of interest rate exposure, they transmit these deposit rates to a lower extent than those with lower interest rate exposure. And the magnitude is not so big. We have, if you compare a bank at the 25th and 27th percentile, it's about 30 basis points. But if you consider the amount of depositors, particularly that old people have, that have most of their savings there, it probably makes up for a lot of money, as I have shown in the previous graph. And we can do the same then for the commercial and regional banks. So for the commercial banks, it's not significant, but there are also quite few banks in this Zister sample by Bundesbank, but within the regional banks where we believe there is the highest variation in the interest rate exposure, we do observe that the magnitude is very similar, and it's likely not to be driven by comparing very large commercial banks to small banks who might set deposit rates for various other reasons and who have likely very different type of depositors. So we can see that these results are driven by sight deposits and term deposits. The saving deposits don't play a big role, and we can see when we look at deposit outflows, I mean, we know that the German banking sector has been stable, so we don't see, again, enormous magnitudes, but in relative terms, you can see that the high interest rate exposure banks who offer lower rates had also higher deposit outflows, and also, as you can see in this graph, they had less deposit inflows. So there is an impact on the deposits. And that's, I think, now when we move to profitability, this is where I think we can differentiate ourselves from the deposit franchise value, because the idea is if everything we have shown so far would be driven by the deposit franchise value, you shouldn't see differences in the profitability. And our argument is that this high interest rate exposure doesn't allow you to competitively attract new deposits and attract and set deposit rates at competitive levels, and that's why you become also less profitable. So you do see this here. You see that the banks with a high interest rate exposure have lower net interest margins than the banks with lower exposures, and this is actually significant for all groups. So this is something that at least shows that in relative terms, despite the German banking sector becoming more profitable after the interest rate hike, those with the highest interest rate exposure did become less profitable. So we have done the same with an IV regression, and the results are very similar, but what we can see is that this is more replicating the insights of Florian Haider, but it's also the paper you have on the U-shape monetary policy, that you can see that in the phase before the interest rate shock, if we take the deposit to asset ratio in 2014, that this does explain the interest rate exposure. So this heterogeneity we have is mostly driven by having a lot of deposits in the rate, in the period before the interest rates increase. So this ultra low interest rates are likely explaining why banks did take up these high interest rate exposures. And then if we use this as an instrument, these 2014 deposit to asset ratios, we obtain very similar results on the deposit rates that I have shown you in the differences regression. So let me summarize our findings and insights so far. So our results are not against the story of the deposit franchise value. As I said, despite having these enormous losses on assets due to this increase in interest rates, the banking sector remained stable, and banks did not transmit deposit rates, which is their main idea. So our paper is clearly not against this. We rather offer an alternative channel and explanation. What we believe is one aspect that I think has not been highlighted with the deposit franchise value: who is paying for this? And if you think about those depositors that have a high fraction of their assets in deposits, it's probably more older people and financially uneducated people who have small stock portfolios. So there is basically a wealth transfer going on from depositors to banks in such a situation, which I think we can put numbers with our exercise to this. When I think about competition, I mean, we did test for market power. We don't find anything in Germany, but I also think that within Germany there is not a lot of heterogeneity in the presence of banks. So we believe that the European bank integration could improve and foster competition, so that we have maybe other European banks coming in and offer better deposit rate. That would be definitely welfare enhancing for depositors. And we believe that there are limits to the deposit franchise value. So after a quite short period of time, interest rates had been again reduced, but if they would have been further increased, maybe due to geopolitical pressures, we could have also observed other situations where maybe depositors would have reacted at some point and not accepted the situation, which would have been a threat to instability. So we don't document here any instabilities, but we believe that there are also some natural limits to it, despite how it went and to our contribution to the current literature. We believe that it's not really market power so much or sticky depositors. It's really also these inability of banks to transmit the rates when they cannot, because they have done this extreme maturity transformation before the interest rate hike. Thank you very much.
Okay. Well, thanks, Rainer, for sticking to the time. Now the discussant for this paper is José Luis Peydró. Let me see if I can get the slides here. Okay, floor is yours, 10 minutes.
Okay, so thanks a lot for the invitation. It's a great pleasure to be here. Thanks, Rafa, for inviting me, and also thanks for the Bank of Spain to invite me. So Basically, this is a great paper. It's a very important question for policy. It's also for academia. They have excellent data, good identification, and very interesting results. There is work in progress. The last result on competition, it was not on the original version. Rainer, we were in a conference at the ECB yesterday, and he sent me over dinner the new version, so I couldn't read the new version. And maybe you have the competition there. But my main comment is going to be about the difference between credit risk and interest rate risk. So I'm going to say that the literature and the policy doesn't differentiate the two. And that's a comment interesting here in a policy institution. But also I'm going to argue that in the paper of Rainer and co-authors, they cannot separate these. And the problem is that for identification, that is going to be a big problem. Okay? So my recommendation is going to be to merge the two of them. Before I say this, let me just start briefly in one slide, the summary of the paper. So it's a paper on monetary policy rates, deposit rates, and financial stability. They use wonderful data from the Bundesbank and the ECB, both deposits and loans, and they use this kind of an expected shock of monetary rates over 2022, 2023. Of course, there, an important issue, which I will not comment, is whether your differentiation across banks is only different because of monetary policy and not because of inflation or the Russian exposure. I will not comment on this, but this is something that you should check. Then the result is one key result, separated in two. Is in the period of low rates, going back to the negative period of rates in June 2014, and at the beginning of 2015 with QE, those banks, some banks took more risk, more duration risk, and those banks were the ones that had more ex-ante deposits. Now in 2022, those banks, they have riskier portfolio in duration risk based on the paper. Then the interest rates went from minus 0.5 to more than 4. And so in that sense, what these banks do with the deposit rates? Could you use like a natural hedge? So they are going to lose on the asset side. They are going to recover profits on the liability because they have these dormant depositors, which are fine to have a low rate, okay, like a natural hedge. This is the paper. As I said, my main comment is going to be on interest rate risk and credit risk. Before I go to the details of the paper, let me just say in general. In general, these two risks, they are separated. One is in Pillar 1 for policy, Pillar 1, the other is in Pillar 2. In academic studies, they are also separated. Now, the issue is that credit risk depends on several factors, but one of the factors is on higher monetary policy rates, and it matters, There was a very nice paper, and Rafa and I talked about this, by Martin Helbig in 1993, saying this is a problem, you should merge the two, and he did that, but in a theoretical paper. This was in the 1990s, and he would refer to these problems in the 1980s. But even after that, the US subprime borrowers in the United States, in the 2000 boom, they took variable rates. For that, there wouldn't be any interest rate risk whatsoever because there were flexible rates. But when interest rates, the Fed changed the interest rates from 1% to 5.25%, those borrowers fell. Not only the subprime borrowers, but other borrowers. So in a sense, when you analyze the risk associated to higher monetary policy rates, you should analyze all the risks that are affected, and in particular credit risk and interest rate risk. So my main comment will be that it will be better to do an analysis of both risk. This was in the 1990s, 1980s, the 2000s. One could argue about accounting. Before I tell you about accounting, we discussed in finance, this is a very finance issue, whether banks hedge value, stock value, or they hedge cash flows. In finance, we like cash flows. But maybe banks, they hedge profits. And if you hedge profits, there is one part on provisions. Lately, in the past, with the stage 1 provisions, this came too late. Nowadays, you have stage 1 and stage 2, IFRS 9, or a different one in the United States. if those provisions were perfectly reflecting credit risk, then if banks hedge profits, not cash flows and book value, then credit risk would be there. But we know also part of Rainer research that even if you are an internal rates-based, you apply an IRB model, you tend to manipulate, so you don't, you don't adjust to the credit risk. You might manipulate on that. You, Rafa, in my, you are a bit fast. You are a bit fast. You are a bit fast by more than 1 minute, Rafa. So not so good. But moreover, some of the banks use the standardized approach. And in the standardized approach, you don't even change that. And I've been a board member here in Spain for a bank, which we use a standardized approach. We follow the tables by the Bank of Spain, and they don't change often. And in particular, they don't change often related to interest rates. So you cite this paper as a paper with Gabriel, with Bank of Spain data as well. In this paper, we talk about monetary policy and financial stability. We address both credit risk and interest rate risk. It's a paper which is forthcoming in the Journal of Finance, and it's mostly country-level data, so it complements perfectly because this is bank-level data. And we find a kind of a U-shaped monetary policy path increases banking credit risk, and we analyze this with many cycles across history, 150 years, etc. Let me in one slide summarize this result, which is that when you raise monetary policy rates, you increase basically a banking crisis risk, but only if before you have rates for low for long. Why? And this is unique to banking crisis. It doesn't happen in non-financial recession, even in the worst ones. And this is over and above, the rates are too low, are below the systematic component of monetary policy. What is the mechanism, which is consistent in part with the paper by Rainer? In the boom, when you lower monetary policy rates for long, then you create a credit boom, an asset price boom. And this is driven by banks, by credit supply. It's not so much about the demand side. The second part is when you raise the monetary policy rates after this period, you are going to create problems on credit and asset prices. And the problems of the banks are not going to be the pure interest rate risk. It's going to be more the credit risk in the data. And then we have one part with Bank of Spain data on credit defaults and credit supply. Since I know that Rafa, and still I have 2 minutes on my watch, but I know that Rafa is above time. So this goes back to the paper. In the paper, they don't differentiate duration risk and borrower risk. The problem is that you cannot do that. Why? Because those German banks that they took high risk in the 2014-2021 risk, they took identically 2 risks, the duration risk and the borrower risk, and the Heider paper is on that. Now, if you take both of those risks, the only way to do your IB is to separate one versus the other, but that's going to be very difficult. So my advice to you would be treat both of them, would be very interesting because the literature treats them differently, and moreover, I think you cannot treat them separately. The last thing I want to say in my last 50 seconds, 1 minute, thank you, is about bank competition. So that was not in the original version. I don't know whether it was in the version that you sent me overnight in the dinner. But we were talking about, like your father being in a village, couldn't go to Deutsche Bank to get a higher interest rate. So you could exploit even that. I don't know whether you have exploited that. Because Germany, I don't know whether you know well, Germany, it has lots of banks, but it's extremely fractured because of the Landesbanks, AB banks, and things like that. So some people cannot afford those higher rates. In those ones, the natural hedge of the deposit franchise is going to be higher. Then you can take more risk on the asset side. So that's something that it would be nice to check. The last thing, and you should not do this because it's complicated, but once you start talking about natural hedge, a question, since you have the data, is the derivatives. So you have all these derivatives on the swaps, on interest rates, and a key question to me is the balance sheet natural hedge. You have the hedging through derivatives. Are they independent? Do they complement? Do they substitute? That would be another layer. Thank you.
Okay, thanks, José Luis, for sticking to the time. Let me give you 1 minute to respond, and then I will open the floor for questions.
So thank you very much, José, for these great suggestions and insightful discussion. I'll just comment on 2 suggestions. I mean, the first one is a very important one, and I mean, I want to hear more why you think it's so difficult to separate. I mean, I know we haven't done it in this paper, but we do have floating rate loans, and we can see exactly what you've said, that if you take the universe of commercial real estate borrowers and you compare the fixed rate loan, those that have a fixed rate exposure and a floating rate exposure, you can see that the probability of default significantly increases for those with floating rates. So we can see this effect, and in the evaluation we do, you can separate this. We haven't done it. It's work in progress. So you're totally right with this. But at least we are trying to address this and see whether how this impacts the market valuation differently from the duration. Through the impact to duration. And the second is on bank competition. In Germany, officially you have thousands of banks, and in fact the Saving Bank Association nationally provides a recommended rate to their banks, or recommended spreads, and this is the same for the cooperative bank organization. So in fact you really have very few banks, and the very large German banks have mostly exited the bidding for deposits because of the low interest rate period before. So it's another thing you can see, consequence of another adverse effect of this time. So I think in fact actually the competition is coming from other European banks, but they are usually then only direct banks and not really present with subsidiaries, and that makes a difference, and this creates a problem that I think we don't have sufficient competition in Europe, and that's why in the US this transmission has been better than in Europe, and that's why in Germany there are enormous rents that banks could earn during the last years, and I'm quite surprised, and this is more now a political opinion, that the financial press has not picked this up, but has mostly written that it's great that banks are doing so well now.
Yes, so very briefly, since you said that you can separate it. So first of all, my point was it would be more interesting to merge the two, like Martin Helbig in the 1990s. Second, you cannot do it. Why you cannot do it? Because the same banks are taking duration risk and credit risk. They are the same banks. When you take the two risks, are either completely independent, which will be weird, or they are complementary or substitute. If they are complementary substitute, the IB doesn't work. Meaning, like, if I want to take more risk, and I take more risk on borrower risk, it will be very weird that independently I take more risk with that borrower either I compensate with risk management and I reduce the maturity, or I gamble and I take double risk and I increase the maturity with the fixed rate.
Okay, well, let's open the floor, Javier and Tomás, and then we'll, okay. Is there a microphone? Okay, you have to speak up.
Have the capacity to pay low rates on deposits, but somehow they only pay low rates on deposits after the interest rate hike if they have previously assumed too much risk. So it's like, I have market power, but I only use it when I'm desperate. Somehow it doesn't fit. So my economics of this is, there are two classes of depositors. Some of them will not care too much about interest rates or will simply have no options away from your bank. And the others will react. And your highly exposed banks are somehow not able or not interested in competing for the second class of depositors. And they're happy enough exploiting the market power on the deposit base. But then you said something like the depositors are paying for sort of this excess risk-taking of the banks in the first place. But actually, my reading of your evidence is that these banks with high deposit base, they knew they could undertake higher duration risk on the asset side, precisely because of having this very stable deposit base. So everything that happens is sort of coherent with this business model. I have a portfolio of longer maturity loans that will make me suffer losses when the rates go up, but I have these depositors that will not react and are providing me a hedge. And connected to José Luis' connection to credit risk, I think this is a little bit too pessimistic view of what banks are doing for society, because the offering of long-term loans at the asset side is protecting the borrowers against interest rate hikes, and then probably is protecting the banking system against a hike in defaults when interest rates go up. So I agree market power for depositors, for deposits is in the background and could be bad for depositors, but I'm not sure that there is an overall so negative and pessimistic view about the maturity transformation role of banks. Thank you very much.
Take a second question here, and then we will move to the next paper. Thomas.
Thank you, Thomas Filippo. Actually, it's a related question, maybe a little bit simpler. I don't understand, so I understand everything in the paper, except there is one claim I don't understand or disagree with, is you said that the depositors in the high rates suffer the consequences or stuff like that, but it's a bit like ratings. You have to do it through the cycle. So you have to integrate from the low to the high rate period and then ask, are they fairly compensated? Because the banks were losing money on deposits before, okay? So that means if you integrate over 10 years, the only question is, does that integrate to 0 or slightly plus or slightly minus? But you cannot say that just because the rates are not keeping up with the Fed fund rate or the target rate of the ECB in the high rate period, the people are worse off. It's a bit like saying, we have implicit labor market contract. So the fact that I don't fire you in bad times and maybe I pay you a bit less in good times, I mean, we think it's a good thing. So this is just an insurance contract. And you have to think about whether over the cycle, people are better off or worse off. And that's very much linked to competition, by the way, because then competition would improve the outcome if and only if the new entrants are more efficient. It's not so much about whether they're going to follow the cycle, it's can they, on average, pay her, which is if and only if their operational costs are lower. Okay. So I think it's important to make that distinction.
You have 1 minute, and then we'll move on.
Okay, tough and very important questions. And so what we are not saying that there are not sticky depositors and that this impacted potentially in the low interest rate period, their risk taking and their maturity transformation. But what we are saying is that those banks that did it a lot, they are less profitable now in relative terms. They do see deposit outflows, and we do see that they have less deposit inflows. So we are seeing that actually those banks that did take a lot of interest rate risk, that they do have negative consequences at the moment. If this deposit channel would work perfectly, and the main motivation was that the net of the Drexler paper was that the net interest margin is constant. We see that it's absolutely not constant around the shock, and that these in our case, affected banks are those who are suffering profitability and net interest margin. So this way, I think it is, and those banks are constrained. So the other banks that did not take these risks are the ones that are taking up now they are offering much more new loans, and they can take advantage of now giving new loans and earn the much higher margins. And I mean, I agree with what you said, and I probably maybe should have phrased it a little bit differently, but I mean, you have to see before they lost 50 basis points on deposits, and now they gain 400 basis points on deposits right after the shock. I'm trying to say that this is a bit asymmetric, I think, but you're right, we should present this in a more balanced way. Yeah.
Okay, thanks. We're moving now from Germany to the US, and Paolo, the floor is yours.
Okay. Thanks so much for including my paper in this conference. It's a pleasure to be here. So the paper is going to focus on the role of banks' maturity choices in affecting the transmission of interest rate risk. The starting point is that maturity mismatch is a defining feature of banking, with banks borrowing short-term generally in the form of deposits and lending long-term by issuing loans or purchasing long-term securities. And this process of maturity transformation earns a premium to banks but also creates exposure to interest rates. So when interest rate goes up, the value of bank asset falls and equity capital gets depleted. And at least in the US, the recent tightening episode revealed a significant degree of exposure in the US banking sector. And the common narrative behind this exposure is that the buildup of interest rate risk was partly reflecting a shift towards long maturity assets that characterized the US banking systems in the latest years. Yet, how banks manage the maturity on their asset side is relatively understudied. So in this paper, I'm going to first ask what are the determinants of banks' maturity choices, and then I'm going to ask whether these choices across maturities are important to understand the transmission of interest rate shocks. First, I'm going to approach this question empirically. I'm going to document some patterns related to banks' maturity choices, combining US regulatory data with the off-the-shelf monetary policy shocks. The first question I ask is whether banks adjust their maturity profile in response to interest rate shocks. And I find that they do, and in particular, after a rate increase, banks tend to reduce the maturity of their balance sheets. I then ask whether these responses are heterogeneous across banks. Again, the answer is yes, and in particular, I find that banks with high deposit to asset ratios are those that tend to shorten the maturity of their portfolio relatively more following a rise in the interest rate. And finally, I ask whether more generally, there is an association between the maturity and leverage decision of the banks. And here I find that high deposit to asset ratios are associated to shorter maturity portfolios. So there seems to be some substitution between leverage and interest rate exposure through maturity. I then build a heterogeneous bank framework to think about how banks choose endogenously leverage and maturity. In the model, banks are going to be able to invest in short and long maturity assets subject to financial frictions. And I'm going to push the idea that the risk premium created by these frictions is an important driver of banks' portfolio choices across maturities. The idea is that when the interest rate goes up, bank net worth falls. This drives up risk premia and make safe short-term assets relatively more attractive to banks. I use the model, I exploit the cross-sectional findings from the empirical section to validate the quantitative model, and I then provide an application to the recent tightening episodes. In particular, the two key findings is that the model replicates the increase in the maturity of bank assets prior to 2022, and it shows that this increase in maturity amplified the effect of the initial tightening. But the effects of subsequent hikes are mitigated as banks readjust their maturity, the maturity of their portfolios by shortening the maturity towards safer assets. So in terms of the empirical part, I'm going to rely mostly on call reports data, which provide information about US commercial banks and bank holding companies. And in particular, it provides information on the maturity of assets and liabilities starting from 1997. This allows me to construct the maturity gap as the difference between the average maturity of assets and the average maturity of liabilities. And it has been shown that this maturity gap is a good measure of interest rate risk exposure for banks. I combine this information with bank holding companies' quarterly filings and off-the-shelf monetary policy shocks. The first question I ask is, how do banks adjust maturity in response to monetary policy shocks? I consider this empirical specification focusing on a sample before 2007. So I regress the change in the maturity gap at different horizons age on the change in the one-year treasury rate, delta RT, instrumented with the monetary policy shock, including time-varying bank-level controls, as well as lagged aggregate controls and bank fixed effects. So the coefficients of interest is beta H, which here I plot at different horizons. So the coefficient is negative. This means that when the interest rate goes up unexpectedly, the maturity gap of banks on average falls. This suggests that there is a shift of portfolios towards shorter maturity assets. Then I ask whether these responses are heterogeneous across banks. So again, I regress the change in the maturity gap, in this case on an interaction term between the change in the treasury rate and the deposit to asset ratio of a particular bank, demeaned as it is done in the literature. Here I can also include time fixed effects because I'm interested in the heterogeneous impact of the shock. And this is, again, the coefficient at different horizons. This is negative. So this means that banks with higher deposit to asset ratios tend to reduce the maturity gap relatively more. So all the banks on average reduce maturity. Banks with high leverage tend to do it particularly so. And finally, I ask what is the relationship between maturity and leverage decision. So here it's a simple bin scatter plot of the maturity gap against deposit leverage. Importantly, this bin scatter plot controls for bank level controls, and it also accounts for time and banks fixed effects. And there is a strong negative relationship, meaning that banks with higher deposit to asset ratios tend to actually have lower maturity gaps. The inclusion of fixed effects here is particularly important because it residualizes on permanent characteristics of the banks, such as permanent differences in market power. In fact, if you remove fixed effects, this plot would go in the opposite direction. In the second part of the paper, I build a quantitative model that is consistent with these key findings. Just to repeat again, the idea that when interest rates go up, maturity goes down, particularly so for banks with high deposit to asset ratios, and the negative association between deposit leverage and maturity. So the key agents in the model are banks that are heterogeneous. They maximize discounted sum of dividends. And importantly, they are able to invest in both short and long maturity assets subject to financial frictions. Households in this framework are risk neutral with a time-varying discount rate. The risk-free rate in this economy is simply the inverse of the discount rate, and I'm going to interpret this shock Z to the discount factor of the household as the interest rate shock in the model. And I'm going to try to understand how banks respond to this shock. I'm not going to go in the details of the model, but I think it's useful to lay down the bank's problem. So banks have access to assets of different maturities, short-term risk-free bonds that fully mature after one period, and long-term risky securities that mature at a rate delta. These long-term assets are equity-type claims to some underlying physical capital issued by non-financial firms, as in the work of Gertler Kiyotaki and Hek Krishnamurti. This implies that the price of this long-term asset is the same as the price of the underlying capital stock, which I denote as Q. The return on this long-term asset is subject to both idiosyncratic and aggregate risk coming from these shocks to the risk-free rate. The key friction is that banks are not able to issue equity. So the dividends are required to be non-negative. And this implies that banks will finance investment using defaultable debt on top of own net worth. So the payoff from investing in a portfolio of short and long-term assets is given by this expression. The short-term asset yields a sure payoff of 1, while the long-term asset yields a risky payoff. Here, omega is an IID shocks that generate heterogeneity across banks, and it is the source of idiosyncratic risk. Interest rate risk exposure in this framework arises through the asset price Q. And the idea is that when the interest rate goes up, the supply of funds in the economy goes down. This depresses the demand for capital and drives down the asset price. So as long as banks are investing in this long-term asset, they are exposed to changes in interest rate through fluctuations in the asset price Q. And in this framework, exposure to interest rate risk depends both on leverage, how much deposits banks issue, and on the maturity of their portfolio. Here is the timing of the model. So at the beginning of a period, the idiosyncratic shock omega is realized, as well as the aggregate shock to the risk-free rate. Each bank enters the period with some net worth and some long-term asset, then with probability sigma receives an exit shock, in which case it either repays and exit or default and exit. With 1 minus sigma probability, there is no exogenous exit shock, so the bank can either default and exit, in which case it gets 0, or continue. If it continues, then it chooses the balance sheet structure for the next period. So it chooses how much short-term and long-term asset to hold and how much deposits B to issue. So here I just want to give you a brief intuition for the main mechanism of the model. So for a bank that holds both assets, it must be that the expected excess return from the long-term asset must compensate the bank for the risk premium associated to that asset. Here, M captures the degree of financial frictions faced by a particular bank I. So if for unconstrained banks, the risk premium would be equal to 0, then the choice is only driven by the expected excess returns. So let's think about an unexpected rise in the interest rate. This has two effects. The first one is that now banks are going to expect capital gains going forward. So this increase in the interest rate depresses the asset price, but the expected price going forward is now higher. The asset is expected to gain value over time. This tends to increase the expected excess return and making the long-term asset relatively more attractive. But there is also an opposite effect. Banks today, they experience capital losses because the price Q is low. So this depletes bank net worth. For banks that are financially constrained, this drives up the risk premium and makes long-term asset relatively less attractive. So if this risk premium channel is sufficiently strong in response to an interest rate rise, banks are gonna reduce their maturity. And the key observation here is that this risk premium component should be more relevant for financially constrained banks, which in the models are banks with high leverage or high deposit to asset ratios. So because they face higher risk premia, banks with high deposit leverage in the model choose portfolios with shorter maturities, so safer portfolios, and following a rise in the interest rate, they rebalance more strongly towards the short-term asset, which is consistent with the empirical findings from the data part of the paper. So I calibrate the model at the annual frequency between 1997 and 2021. I fix some parameters. Then I estimate the interest rate process from the data, fitting the process for the 10-year real interest rate in the model and in the data. And finally, I calibrate the remaining parameters to match some bank balance sheet moments. In particular, I match the average maturity gap and the cross-sectional dispersion of this maturity gap across banks. Capturing the idea that in the data, I see a significant amount of dispersion in interest rate risk exposure if I look at this measure of the maturity gap. Once I calibrate the model, then I can simulate a panel of banks from the model, and I can try to see if it can replicate the empirical findings from the previous section. So here I am running a close regression to the one I showed you before. I'm regressing the change in the maturity gap on the interaction term between leverage L of a bank and the change in the risk-free rate in the model, including leverage as a control together with time fixed effects. So in the model, there is no permanent heterogeneity, so it doesn't matter if I include bank fixed effects as well. This regression corresponds to the first column of this table, which compares this estimated coefficient in the model and in the data. Here I also want to specify that I'm doing some normalizations to make the model and the data comparable. That's why the data coefficient here is different from the one from the impulse response functions. The second column includes also an interaction between bank size and the monetary policy shock. And the last column estimates also the average effect, which is in blue. So the average effect is negative in both the data and the model. So when the interest rate goes up, maturity tends to fall. The coefficient is much smaller in the model than in the data, which is a drawback of this calibration. The coefficients on the interaction term is also negative. So banks with high deposit-to-asset ratio, because of this higher risk premia, tend to respond more strongly to the shock. And I do the same for the last fact about the relationship between maturity and leverage. So here I'm running a simple regression of the maturity gap of a bank on its leverage size, so log of total assets, again including time fixed effects. And here are the results. The coefficient is negative both in the model and in the data. So banks with higher deposit-to-asset ratios tend to be associated to shorter maturity portfolios. So in terms of aggregate implications, I just want to go through some key features of the model. So here I am plotting the impulse response function implied by the model following a 1 standard deviation increase in the risk-free rate. So let me first focus on the balance sheet structure of the bank. So here we see that following the increase in the interest rate, banks tend to reduce the riskiness of their balance sheets in two ways: by reducing leverage, so by reducing the deposit-to-asset ratios, and also by reducing the maturity of their portfolios, by reducing their maturity gap. This despite the fact that the expected excess return associated to the long-term asset tend to go up in equilibrium. In terms of other macro and financial variables, the model predicts a sharp contraction in bank equity values, a fall in the price of the long-term assets, as well as some response in terms of output drop, and a strong decline in investment. The question that I now ask is how important is bank portfolio reallocation across maturities for macro dynamics? So to answer this question, I solved two alternative models. One, where banks have no access to short-term assets, so they can only invest in the long-term assets. They can still choose the size of their balance sheet as well as leverage. The second is an alternative model where banks invest a fixed proportions of their assets into the long-term and the short-term asset. Again, they are left free to choose leverage as they please. I solve this model, then I go to the data, I recover the sequence of shocks such that the model implied 10-year interest rate matches exactly the empirical counterpart. This is my sequence of interest rate shocks. I then feed them into each model variant, and I compare how the models behave, focusing in particular on the recent tightening episode. And the results are reported in this table. So the upper part compares unconditional moments in the model with endogenous maturity with the counterfactuals. So unconditionally, the asset price is less volatile in the counterfactual models relative to the baseline, while the volatility of bank equity is very close. But the picture looks very different once we look at conditionally to the tightening episode of 2022. So first of all, the baseline model predicts that between 2018 and 2021, banks increase their maturity gap by 2 percentage points. And the model rationalized this increase in the maturity gap because interest rates in the pandemic and post-pandemic period were surprisingly low. So with low interest rates, banks in the model tend to increase their maturity gap, which is consistent also with what was observed in the data. Once the tightening happens, and here I invite you to look at the last column of the table, if banks are prevented from increasing the maturity of their assets, the decline in asset prices and bank equity values is lower. Here, banks do not increase investment in long-term securities, in long-term assets, and this mitigates in the counterfactual the effect of the initial tightening. But the effect of the subsequent tightening between 2022 and 2023 is actually amplified. In fact, the effect under the fixed portfolio share model is significantly larger than under the baseline. The reason is that in the model with flexible maturity, once the initial tightening happens, banks readjust their portfolios towards shorter maturity asset, and they insulate their balance sheets against further rate increases. If we take out short-term bonds in the model, there is no way banks can self-insure against this type of risk. And as a result, in the second column of the table, you can see that without short-term bonds, all the effects of the tightening are significantly amplified. So let me now just conclude. So in this paper, I document that banks respond to interest rate hikes by shortening the maturity of their asset. The response is more pronounced for banks with high deposit leverage. I develop a macrofinance model which endogenizes both leverage and maturity choices. The model matches the empirical patterns and highlights the role of risk premium in shaping these maturity choices, which are important to understand the transmission of interest rate risk and the effect of monetary policy tightening. And in the paper, I also discuss some implications of these frameworks in terms of banking policies, so both liquidity and leverage regulation. Thank you very much.
Okay, well, thanks, Paolo. Now let's move to the discussant of this paper, who is Rustam Jamilov from Oxford. So the floor is yours.
Okay. Thank you very much to the organizers for asking me to discuss this very nice paper. So what this paper does is it introduces endogenous exposure to interest rate risk into the canonical Gertler-Kiyotaki-Karade class of models, which has been very influential both in academia and also in policy. The long-term asset is exposed to interest rate fluctuations while the safe asset is not. Banks have a choice to expose themselves to the risky asset versus the short-term asset. It provides a self-insurance mechanism that is absent in the standard model, and on average that strengthens financial stability because the banks have an additional margin of adjustment to withstand aggregate shocks. The short-term asset, it's a hedge against sudden policy rate hikes, and in the standard models the only choice that the banks have is to adjust their leverage ratio, but within portfolio composition is the same. And I think this is precisely the correct margin for the analysis of the recent inflationary and hike and subsequent banking crisis episode. So I think it's going to be a very important paper from the policy perspective, and it's a much awaited addition to this literature, which has so far lacked a proper modeling of endogenous interest rate exposure. So a bit of an overview, and in order for us to see Paolo's contribution in the bigger picture. So this is the standard macro banking model. It's a standard representative bank macro banking model of Gettler, Korade, Kiyotaki. You have an infinitely living financial intermediary. It borrows via one-term deposits from the household. The deposits could be insured, could be not. It invests into the risky asset. In the standard model, the asset is just a neoclassical capital. It could accumulate, or it doesn't have to. The bank usually has an incentive to leverage to infinity, so we limit the leverage multiple either through a hard constraint, which is in the original papers, or you could do it through exit choice that is priced into deposit rates, as in Paolo's case. So the financial accelerator logic is clear and obvious here, because changes in asset prices can hit banks through tightening of collateral constraints in crisis, for example. The appeal of this modeling device is the linearity and aggregation. That's why this framework has been so influential. But the drawback is that the distribution of banks typically does not matter, because everything aggregates explicitly. We don't really have any cross-sectional heterogeneity. And another drawback, for tractability, there is only one asset, aggregate capital. So over the years, people have introduced heterogeneity into this framework. The simplest way to do is through the ex post way of the Bewley, Huggett, Ayagari approach of introducing ex post heterogeneity into the decision problem. So here we have this Xi object, which is uninsured idiosyncratic bank return risk. It generates a distribution of banks, because banks now are identical, exposed, they're different because they draw bank-specific returns on the same portfolio. It could be autoregressive, it could be IID, so there are different ways of doing it. Now, in this situation, the distribution of banks is an endogenous state variable, and it's usually dynamic if you have aggregate uncertainty. So you have to forecast this distribution. You have the Crosell and Smith logic, and sort of people have done it, and I have a paper on that also in the past. So now within this environment, you still have only one asset, so you don't have the maturity, the proper modeling of the maturity choice. So this is where Paolo comes in, and he says, well, it's a severe limitation of the standard models. Let's introduce short-term government bond, AS. It's a safe asset. So now on top of the standard dynamic banking problem, which is already not easy, now you need to solve an additional portfolio problem. So banks choose the optimal leverage ratio, and on top of that, they choose the composition of the balance sheet, the share of long-term versus short-term assets. So the maturity gap becomes endogenous, and it responds to discount factor shocks, which could either amplify or dampen the monetary transmission mechanism, and it has first-order effects on financial stability. So I have a few comments, mostly to improve the paper, but otherwise I think it's already an important contribution. So the first comment is immediately came to me when I was reading it, the households are risk neutral. If banks are risk neutral, I think it's totally fine, but if households are risk neutral, the assumption is very strong. Having at least log utility would go a long way of fixing it. The issue is that the risk-free rate will not react to any aggregate shock except the discount factor shock, so Paolo is very smart, he understands that. But that can potentially limit the analysis, especially with background aggregate risk. There is no margin for the household to smooth consumption because there is no precautionary savings motive if the household is neutral. So for instance, if you want to do TFP cost push shocks, which would be nice to do in this environment to simulate the inflation surge, for example, you cannot do that credibly because the interest rate will not react. It will only react to the discount factor shock, which it's designed to do for exogenous reasons. And it could have you could say, well, it's a numerical or a quantitative issue, but actually it could have first-order effects on the market transmission. And so I have this picture from the same paper before. So here, just for example, you can see impulse responses to a TFP shock with log utility or with risk-neutral households. If you compare the red lines and the yellow lines, you have qualitatively different effects on the return on capital and vastly different effects on how banks respond and how output responds to the same TFP shock if you have a risk neutrality and if you have risk aversion. So that's something to think about. So the second comment is on the empirical test in the paper. This is the main empirical regression. So you have the maturity gap as the dependent variable. So you have the monetary policy shock as the main independent variable, and you also have characteristics to look at the heterogeneous treatment effects. So I think this is a fine exercise. It's useful both empirically and to discipline the model. But I think the perfect exercise is actually the second equation which I wrote. So here, the outcome variable is something that is important for sort of welfare. It could be bank level lending. It could be market values if you manage to do high frequency, or deposit growth. So some quantities, changes in quantities on the left-hand side, and then on the right-hand side you interact the interest rate shock with the lagged maturity gap. So because one of the conclusions in the paper that the maturity gap amplifies financial it's a source of financial amplification, or it's a dampening on average for financial stability. So the right way to think about it, or a complementary way to the way you already think about it, is to look at the heterogeneous effects of monetary policy on investment, on lending, where the characteristic of heterogeneity is the maturity gap. And I think it complements the existing literature very well, because this particular regression, I don't think it has been run in recent years. So it would be great to see something like this. So this is from Ottanello and Winberry, where the dependent variable is firm investment. And so this is for non-financial firms. And on the right-hand side, you have the interaction of the monetary policy shock and lagged firm leverage. Or you can do something like this for banks, when you have bank lending on the left-hand side, and then on the right-hand side, you have the interaction between the monetary policy shock and a lagged bank default risk or bank assets. Again, to look at the heterogeneous effects of monetary policy, where the maturity gap is the characteristic. Finally, I have a few minor comments, and then I conclude. So these are more just to clarify things. So there was this unclarity for me with regards to how you deal with deposit insurance. So there was this word that triggered me a bit, the bailout, because we all know that the bailout is an additional externality, and it wasn't clear whether banks internalize it. I think what you actually mean is just deposit insurance. I think that's fine. Labor supply could be endogenized. And it would be nice to see that the distribution of banks actually in terms of histograms or densities, how close they are to the data. And finally, because you use bounded rationality methods, numerical solution accuracy is important, so it would be nice to look at some Denhan statistics or accuracy statistics in the paper. So to conclude, I think the standard models with bank heterogeneity abstract from endogenous interest rate risk exposure, not because we think it's not important, because it's very hard to do. And Paolo provides an important contribution to this literature with some minor refinements. I think this will be an influential paper both for us academics and for policy as well.
Okay, thank you, Rustam. 1 minute response, and then I'll open the floor.
Thanks so much for the discussion, Rustam. So for the risk neutrality, I agree it's like a strong assumption that I not necessarily like. The issue here is that it would require to have consumption as an additional aggregate state variable. So it makes the computation of the model harder, but it is for sure the first dimension I would try to improve the model to have some degree of risk aversion. So about then the regression, I completely agree. I started looking a little bit in the effects on market values, equity prices for banks, and you indeed see that banks with higher maturity gaps tend to respond more, which is consistent also with the other papers in the literature like English and co-author and so on. But I think it would be a very useful empirical moment to have in the model to try to match and discipline some other parameters. Already. And yes, deposit insurance is just deposit insurance. And I would definitely need to plot the densities. It's just that since I don't have permanent differences in banks, that may make the comparison of raw distributions a bit more complicated and cumbersome.
Okay. Well, time for one question from the audience, if there is any such question. Okay, well, let's thank the speakers and discussants, and we move to the next session, which is on bank heterogeneity and monetary policy transmission.